Alrighty. All right, it looks like we are almost live here. I am live on X, I believe. Let me get ready to go live on YouTube. Yes, change visibility to public. Save. Okay, I believe I am now live on YouTube and X for the dual stream. It is November 5th, 2025, and we are here to review Lemonade's Q3 2025 shareholder letter and earnings. I am very excited about today. As you guys can see on the screen, Lemonade's already up. It's a little too bright. A little too bright this morning. Yeah. Okay. Oh, now I can see it. Yeah, Lemonade's up 13.20% so far this AM. That is a $7.74 move so far this AM. So let's check out the shareholder letter, read through it, see why people are excited about this one. I have an idea. Let me. I don't want to spoil it for you guys, but my guess is we are starting to see operating leverage show itself in a big way. Like I'm guessing free cash flow and profitability. It's not to profit yet. But I'm guessing that line is looking like straight up, and people are starting to see, hey, a couple more quarters and this thing's about to start shooting off rapid profitability. So that's my guess. That's my guess is, operating expenses, they're probably staying relatively flat. We're probably seeing a continuation of growth acceleration. And I'm guessing that is why we are up in the pre-market right now. So I'm just going to quickly check before we jump into this letter and make sure that all of my broadcasts and stuff are looking good. Yep. Okay. Looks like got the control room running. We are looking good with 9 concurrent viewers on YouTube, and I'm guessing we have a lot more on X already. Let me pull up X Studio as well, just so I make sure that everything is looking good. All right, let me post this to my timeline. Live for Lemonade Q3 2025 earnings. Join me for sis of the letter and call. And then I need a rocket emoji for this tweet, and we will be good to go. And then I need to be able to see your guys'. I think last time I did not have chat enabled, just 'cause I didn't know how. So this time I believe I have chat enabled as well. So I need to figure out how I can actually read it. Okay, here we go. Okay, so yeah, it looks like we are up to 10 viewers on X as well. Let me just check this. I want to make sure sound's coming through good. Oh, man, all I see is black on X. Apologies here for the beginning. All right, let's see here. Oh yeah. Okay. We're good. Sound's coming through strong. We're at 100 viewers on X now. All right. Everything is looking great. Okay, sweet. All right, so without further ado, let's jump into this shareholder letter and let's see what all of the excitement is about this morning. Just so you guys know, full disclosures here, nothing I say on this stream is financial advice. It is all just my personal opinions. Also, full disclosure, I own 100,000 shares of LMND, so I'm a bit biased, all right? I'm going to be you know, fangirling a bit here. This is, you know, about 100% of my net liquidity is in this company. So the disclosure's out of the way. I'm not your financial advisor. Let's get into this. All right. So we had $1.15 billion in in-force premium, 1,158 million. That is the fastest IFP growth quarter that we have seen in a long time. That is super, super exciting. Finally hit that 30%, which means, guys, Q4, we're probably going to be above 30%. You know, this is ahead of guidance. So this is looking really, really good. Premium per customer up 5%, solid growth there. And just so you guys know, this premium per customer number is always going to be growing faster than inflation. So owning stocks, incredible inflation hedge, especially insurance companies. Customer growth grew by 24%. We are now nearing 3 million total customers. Also, just so you guys know, another reason why we're going to just continue to see this premium per customer rise is because Lemonade is growing IFP in car. They're growing premiums in car insurance, and car insurance is a lot bigger average, you know, annual premium than a lot of Lemonade's current policies, which are renters, pet, and that sort of thing. And this is part of Lemonade's strategy as well, where the majority of Lemonade's customers are actually under 35, like myself. And Lemonade is purposely targeting pet and renters insurance, and now car insurance, to young people that traditional insurance companies do not want. Why? Because young people don't have money. Young people don't have assets. So it's not really worth targeting us because you can't make that much off of us. But Lemonade, they're thinking long term. And they're like, if we can grab customers early before the big boys want them, and we delight them with an incredible customer experience, which I have experienced myself, as I am also a Lemonade customer. I currently have 4 Teslas insured with Lemonade. My home that I am in right now is insured with Lemonade, and AI bot Maya, and the entire customer experience is just incredible. They delight us when we're young, and guess what? We buy our first car, and now we add car insurance to our pet insurance. We buy our first house, and now we switch from renters insurance to home insurance. And premium per customer is going to be growing as customers grow. Okay. In-force premium, you can see this ramp here this is a year-over-year ramps. You see the acceleration just very clearly from 2023 to 2024, to now 2024 to 2025. Okay, so now we are seeing a shrinkage of losses. This is what I was saying we should expect here. So we're going from a $24 million adjusted EBITDA loss, a $68 million net loss last year, to now only a $26 million adjusted EBITDA loss and a $38 million net loss. So you can see we cut that net loss by $30 million. We almost cut it in half year over year. And what we're starting to experience is operating leverage, because Lemonade is able to grow customer count without growing employee count and without growing very, very slightly, barely growing operating expenses, excluding growth spend. So net loss here as a percentage of GEP, you can see 36, 32, now only 14%. So let's check out gross profit here. You can see this ramp, 41% gross margin here. That is a huge jump in gross margin from last year, where we were at 27%. This is just incredible, to be completely honest. Like you never see companies growing gross margin like this, or very, very rarely. So that's really good to see. $80 million in gross profit. Adjusted free cash flow is 18 million here, with cash flow from operating activities of 5 million. So we'll learn about why we got a little bit of a dip here in the letter, I'm sure. Okay, dear shareholders, in Q3, we continued both our growth acceleration, crossing 30% in-force premium growth ahead of schedule, and our steady progress towards profitability. Below are the highlights of the quarter. So top line at $1.16 billion in in-force premium grew 30%, our 8th consecutive quarter of accelerating growth, where every single quarter grows faster than the quarter before it. Gross profit increased 113% year over year to $80 million, while gross profit margin improved by 14 percentage points to 41%. I got to open my window real quick, guys. I'm getting a little bit hot here. These numbers are coming in too hot. All right. Luckily, it's cool now, so that fresh, cool air is going to just be pouring in. Okay, gross loss ratio improved 11 percentage points year over year to 62%, while the trailing 12-month loss ratio was 67%, both our best ever results. Bottom line, adjusted EBITDA improved 48% year over year to negative $26 million. The net loss this quarter was $38 million, a 45% improvement. All right, cash flow. We generated $18 million in adjusted free cash flow and $5 million of cash flow from operations. So while Lemonade is still pre-profit here, this number is important as far as it shows you that there is absolutely no fears that we should have that Lemonade is not going to be a continued going concern. Lemonade is not at any risk, contrary to the 30%, well, nearly 30% float that is shorted. Contrary to their popular belief, there is really no risk that Lemonade is going to go bankrupt. I mean, we're generating free cash flow here, and the cash balance is growing. All right, so even though we're not to net profit, this is important to keep in mind. All right, 2 years ago, we were growing in-force premium at 18% with a 19% gross profit margin and a net loss representing 36% of gross earned premium. 2 years on, in-force premium growth has accelerated to 30%, while gross profit margin more than doubled to 41%, driving triple-digit gross profit growth. We've maintained a 3-to-1 lifetime value to customer acquisition costs. That means that if they pay $1 to acquire a customer, they are getting $3 in what they view as profit back, not revenue. They believe that the lifetime value in profit is 3 times the customer acquisition cost. So we've maintained a 3-to-1 LTV to CAC ratio as marketing spend more than tripled, thanks to AI-powered improvements in segmentation and pricing. So this is really important to keep in mind as well. So as someone who has run an e-commerce brand that's done $1 million in revenue in a year before, I have experienced firsthand your return on ad spend drops significantly as you start trying to ramp your ad spend, especially if your ads are really bad like mine were. But Lemonade has tripled their marketing spend and have maintained the 3-to-1 lifetime value to customer acquisition costs. That is incredible. And this is a function of what? Well, they want to increase spend. They can still unlock a new state. And then all of a sudden you unlock a fresh set of potential customers who haven't been seeing your ads before. So you can increase spend without decreasing the return on ad spend by growing into new geographies. Another way they're able to do this is they add more products. Another way they're able to do this is they're just such a tiny fish in such a huge, huge ocean. Insurance, so much is spent on insurance every single year, and Lemonade is still tiny. So, we can 100x, and Lemonade will still be a relatively small insurance company. All right. Thanks to AI-powered improvements in segmentation and pricing, AI also enabled us to keep our operating expenses, excluding growth spend, almost flat. The result, net loss as a percentage of gross earned premium has improved by nearly 2/3 to 14%, and our path to profit is plain to see. So check out this net loss as a percentage of premiums. Yeah, this is about to hit zero, guys. And then after it hits zero, we're not stopping. We're not stopping there. It is going to go positive. And then it is going to go very, very positive. So this is the type of trend line you want to see from almost a 100% net loss, which is insane in 2021. And by the way, guys, here if I how do I want to do this? I don't want to mess up my organization of the stream here. Let's just do this on Google. If we go back to 2021. So let's max out since we went public. In 2021, when Lemonade had nearly 100% net loss as a percentage of premium, the stock was almost a $200 stock. Now, this was Q3, so I guess if we jump ahead to Q3, you can see we were about the same price in 2021 as we now are in 2025, when we're about to flip to profitability, as we were when Lemonade, it was far from a certainty back here. It was far from a certainty when they're losing almost 100%, a net loss of almost 100% of premiums. There was a very good chance Lemonade was not going to exist as a company. And investors were willing to pay way more for it, almost 4 times as much, 3 times as much for a company that was far riskier than the market is now willing to pay for a company that's about to flip to profitability. So just keep this in mind. The market is extremely irrational. I like to think I'm a pretty irrational person, but I have to try to remind myself, if the market decides to turn on Lemonade and get positive, and the almost 30% short interest decides to cover, we're going to go far beyond what I believe fair value is, which I currently believe fair value, based off of my discounted free cash flow model, which you can see in some of our YouTube videos. I believe that at a 15% discount rate to 2035, Lemonade is currently worth $190 per share. That means that I believe if I were to pay you $190 for a share of Lemonade today, I would get a 15% annualized return on that purchase every single year over the next decade. Okay, so that's fair value is 190. The market never stops at fair value. The market is insane. The market gets absolutely ridiculous. It gets ridiculously pessimistic, like when Lemonade was trading at $10 in October 27 of 2023. And it gets ridiculously, over optimistic. So hello, everyone in the stream. By the way, we are now at 442 viewers on X, and we are up to 27 viewers on YouTube. Google, you're letting me down. What are you doing? So we're up to, we're getting close to 500, and those numbers are going up almost as fast as Lemonade's numbers are going up themselves. So yeah, just remember, the market can be irrational. So this is something I keep trying to tell myself, because those of you guys who have been following me, you'll know that I sold about $1 million of Lemonade yesterday. I was at about a $7 million position. Now I'm down to about a $6 million position, although we're flying today, so I'm not exactly sure what it's at this morning. But I did that because, the market this time, Q3, we sold off into earnings. So I was just pouring into it, and then we jumped 30% on earnings, right? Well, this time we've been, running into earnings a tiny bit. So I was just a little bit more cautious because I do use leverage. I didn't want... My headphones just shut off for some reason. I didn't want for there to be a huge pullback on any sort of short-term disappointing numbers, which I'm sure don't affect long-term at all. I didn't want any sort of short-term pullback to force margin calls. So I reduced my position a little bit. already in pre-market. I've actually been buying back some of what I sold there. But I've been trying to tell, like, I know I'm overreacting and I know I'm moving too quickly. And I know that from my track record, like I bought Palantir at $7.70. I sold it way too early. Like I got a little over a double out of it and I sold it. That's so stupid. The market does not rationally stop bidding a company up after it hits fair value. No, that's when the FOMO starts. And that's when the like price really runs up. So I'm trying to tell myself, like, you know, Lemonade could hit 400 in 16 months. Like we could go parabolic. We could go insane. We could go far beyond fair value. And I'm trying to remind myself of that because I have an inclination of conservatism where I want to play it cautiously when we're still 6, 12, 18, 3x under what I think fair value is today. Like how stupid is it to sell some shares like at 1/3 of fair value when the market is going to run far past fair value? I don't know when, but at a certain point in the future, because it always does. Okay, let's keep going. That was enough of a rant. I'm ranting at myself here. I'm talking to myself here because, yeah, when you're very rational, you have to rationally understand the irrationality of the market and let that irrationality work for you sometimes. Okay, grow the business and scale the operation. Continued execution of long-standing financial strategy. And just so you guys know, once we are done reading through this letter, I'm going to be chatting with you guys a bit, going through a couple kind of long-form posts I wrote, and then we're going to be jumping into the earnings call, which will be starting in about 50 minutes. Okay. IFP growth rate. So you can see this acceleration. This is so crazy. Like this is exactly what Wall Street should want. Why are we 30% shorted, Wall Street? Is this not like the very ideal perfect company? Like 8 quarters of IFP growth acceleration alongside sustained gross loss ratio improvement yields a near quadrupling in gross profit. Okay. So in insurance, well, first of all, you just appreciate this. This is beautiful. But now in insurance, what the insurance company keeps is what is left over after they pay claims. So obviously, an insurance company is going to be charging more for the policy than they expect that they're going to pay you out in claims. That's how they survive as a business. That's how they make money. And the reason why individuals buy insurance is because overall, that is true that Lemonade's collecting more in premiums than they're paying out. But on an individual basis, if my house was to burn down, then, you know, individually that, you know, it could save me. It could really save me. Even though overall, you know, everyone's house isn't burning down. So Lemonade overall is collecting more premiums than they're paying out. On an individual basis, it can be really important. But check out this loss ratio. So this is the percentage of premiums they're collecting that are getting paid out in losses. So in 2023, 88% of every dollar that they were collecting in premiums, Lemonade was paying out in losses. Well, as AI, because Lemonade, remember, is an AI company, they have an LTV model, which is calculating lifetime value. And I think they're on I want to say model 13 or 14 proprietary AI risk model that is continually learning off of all of the data that's coming through Lemonade's AI flywheel. All of the data that comes through, Lemonade's AI is learning off of so that the next customer that comes in, the AI prices it slightly better. Next customer that comes in, price slightly better. And the AI brain is literally learning how to be the best underwriter in the world. And a human underwriter, there's some good underwriters, there's some bad underwriters, but a human underwriter is not underwriting 2.5 million customers in a lifetime. Well, you know, Lemonade's AI, it's already underwritten 2.8 million customers so far. And this number is just going to keep growing. So the AI is just going to have, it's like full self-driving. The AI is going to have so many millions of miles of driving data that humans are never going to be able to be as safe, as good as an AI driver. Well, that is exactly how you can think about how Humans are never going to be as good at underwriting as an AI that has that much data, that much experience. So this loss ratio dropping from 88% in Q3 2023 to now 67% in Q3 2025, it's proof. It's proof that Lemonade's AI is getting better at pricing risk. And it is proof that this AI model is going to work. If you guys don't know, 98% of Lemonade's policies, they're not sold by a human. They're not sold, through an insurance agent who is then going to be taking a cut forever. AI bot Maya, an AI is selling these policies direct to the consumer. And Lemonade doesn't have to pay Maya. I mean, the actual Maya who works at Lemonade, they have to pay, but the bot Maya works for free. And that is why Lemonade's operating leverage looks like this. In-force premium versus OpEx excluding growth spend. So this is you back out the money that Lemonade is pouring into ads to continue growing customer count. You back that out. And this is just in-force premium to the operating expense to sustain the current customer count. We were at $87 million of operating expenses back in 2022. So this is now a full 23, 24, 25, whole 3 years later. 3 years later. In-force premium has grown from $609 million to now $1.16 billion. And operating expenses are almost flat. Like I think if you did like a percentage increase every year, I don't know what this would be. Maybe like 5% or something. Yeah, I'm not exactly sure. But this is hardly any growth. We've gone from 87 million of operating expenses to 95 million, an $8 million increase, an $8 million increase only in operating expenses in 3 years, while top line doubles. That's pretty good. That is pretty freaking good. So this is what is going to lead to a 20x. This is what Lemonade said during the 2024 Investor Day. This is what's leading to a 20x in free cash flow over the next doubling of top line. So top line doubles, goes from here to here. Free cash flow goes from here to like freaking through the roof, through the second story, 20x compared to a double. So that's sustained operating leverage, and that's what operating leverage driven by AI and automation looks like. Okay, Lemonade Car. This is going to be big. We are also up to 700 viewers on X. So hello everyone. Glad you're here. This is such an exciting quarter for Lemonade. All right. Car is delivering all that we could have hoped for. Gross loss ratio improved 16 percentage points year over year to 76%. Okay, anyone who's afraid that Lemonade wasn't going to be able to do car, they weren't going to be able to price it accurately, you're wrong. Okay, it's proven now. Lemonade's going to succeed at car. They're going to succeed at car. Okay. Within a broadly improving book, we saw notable improvement in new business loss ratios, demonstrating that our latest pricing and risk selection models are delivering strong results from inception. As a result, we leaned in and car grew ahead of our internal financial plan. We ended the third quarter at $163 million of in-force premium, representing a 40% year-over-year growth in car. Guys, car is so huge for Lemonade. This is big. This is really big. Okay. More than half of new car sales in the quarter came from existing Lemonade customers. This reinforces one of our core strategic advantages, the ability to drive customer acquisition free sales as our growing base of happy customers, improving unit economics, and expanding wallet share. To our growing base of happy customers and expanding wallet share. Okay. Okay. I can't read, guys. Bear with me. All right. Looking ahead, we expect car growth to continue to accelerate, fueled in part by total addressable market expansion from new state launches, and increased brand/growth investment. We expect to launch Lemonade Car in Pennsylvania in the coming months, after which we'll be live in 9 of the 10 largest U.S. cities. All right, very cool. Looking forward to the Pennsylvania launch. And like I said, this is partly how they keep that. I mean, besides the fact that they can just get current customers to just sign up on Car because current customers love Lemonade so much. The fact that they can just continue launching in new states is how they keep that customer acquisition cost low while accelerating growth rate. All right, AI highlight. And by the way, guys, one thing that's really important, and I think this is a little bit of a side tangent, but I think a lot of the reason why people get burned buying growth companies is because they're buying a company looking backwards at what kind of growth it was putting up in the past, with no real understanding of how much growth runway is left, like how big the market actually is, what the competition actually looks like. And that's why people get burned, because they buy a company that's priced at a very high multiple because looking backwards it has a high growth rate. And then all of a sudden growth starts slowing down, the stock crashes, and people get burned. Well, with Lemonade, you look at the total addressable market compared to Lemonade's current size, and the potential growth ahead is mind-blowing. You look at their backwards revenue growth and what their forwards revenue growth looks like, and it looks like it's going to be able to keep accelerating. And you look at competition, and guess what? There is no AI competition. AI companies, when an AI graduate from MIT says, I'm going to do an AI startup, you know what the last idea they have is? Starting an insurance company. No one wants to start an insurance company. So because of that, Lemonade's kind of running a race on their own in an ocean so large it's hard to comprehend. Like insurance is bigger than the automotive industry. Insurance is bigger than almost every single large industry that you can think of. So like Lemonade is tackling a bigger total addressable market than Tesla is tackling. Just so you can understand like the size. Like Tesla is a $1.5 trillion company. Now, Elon is, making humanoid bots and stuff. He wants to create brand new markets that have never existed before. But if you just look at automotive, Lemonade is going for a much larger market than even Tesla is going for. And Lemonade is a tiny company, tiny company compared to Tesla. Like to hit $1 trillion valuation, I think we have to, what's the market cap we're at right now? We're currently at $4.3 billion. So a 100x would be $40 billion. So that means we need a 200x to hit $800 billion. We need a 200x for $800 billion. And we would still be like half the size of Tesla. And our market is bigger than theirs currently. So just keep this in mind, okay? There's a lot of growth runway ahead, and we're just getting started. Okay. It is challenging to benchmark AI usage by insurance companies, as incumbents publish very few efficiency or automation metrics. Enter the LAE ratio, short for loss adjustment expense ratio, defined as the cost of handling claims divided by gross earned premium. Okay, so this is like the human cost of handling customers. It's a good proxy for efficiency. The lower it is, the more streamlined the operation, offering a rare apples-to-apples benchmark across insurance carriers. Okay, so we're getting a new benchmark to track here. Loss adjustment expense ratio, defined as the cost of handling claims divided by gross earned premium. Okay, wow, look at this. Cost of handling claims. So 13% was the LAE, which once again stands for loss adjustment expense ratio. So the cost of handling claims was 13% of premiums, I'm guessing. Then in 2023, it dropped to 11, 2024, 9, 2025, 7, and they're projecting into the future it's going to keep going down. Guys, AI is going to transform the entire freaking economy. This is crazy. They've cut the cost. The cost to Lemonade of each customer has been cut in half since 2022. That's crazy. And it's probably going to get cut in half again. I would not be surprised we see this 3.5% 3 years out, something like that. That's wild. Why? Because Lemonade already showed they doubled customer count, from 1 million, actually now more than doubled, to 2.8 million, 2.86, and they've kept employee count flat. Okay, so this is how this gets better. They've added 1.5 million customers and haven't had to hire more employees. Like, that's AI efficiency right there. That's exciting stuff as an owner of the business. Over the past 3 years, we've almost halved our LAE ratio from 13% to 7%, largely due to our ability to harness AI to drive automation. Notably, our claims department shrank in absolute terms, even as claims volume increased by 2.5x during the period. I'm going to drink some coffee here. Drink some water, drink some coffee. Guys, I don't think there's been a better time to be an investor in all of history. Like the AI revolution, the productivity revolution that's coming from AI is bigger than the industrial revolution. This is bigger than the internet revolution. This is going to be the biggest productivity increase that humanity has ever seen from artificial intelligence. And here is perfect example number 1. Notably, our claims department shrank in absolute terms, even as claims volume increased by 2.5x during the period. Said differently, we have seen a near tripling in claims handling efficiency. We have demonstrated our ability to transform claims handling expense, long considered a variable expense in insurance, to a near fixed expense. So this is the other thing people don't understand, okay? Lemonade currently is a $4.3 billion market cap, right? Let's look at Progressive stock. Progressive is currently a $122 billion company. And what is Progressive's market share? I think Progressive is only auto insurance. Progressive auto insurance market share. Okay. Progressive U.S. auto insurance market share is approximately 16.7%. All right. Progressive, do they have an international business? I already know the answer to this, but I'm like a lawyer asking a question I already know the answer to make a point, okay? No, Progressive Corporation does not have an international business. But it did have one in Australia that it sold operations in 2017, okay? Why do these companies not serve international customers? Well, because their legacy. If they want to serve another country, they need to set up an office there and hire a bunch of employees there. It's very hard to expand across the ocean, back in the Mayflower days when these companies were getting started. I'm only partly joking here, by the way. When we were headed across the Atlantic trying to get to America for the first time and we thought it was the edge of the world, back then it was hard to run an international business. So, you can't fault Progressive. So they have 16% market share just in the US, just in auto insurance, okay? Just in auto insurance. They are a $122 billion market cap company. And they are not AI. So So their claims expenses is variable, not fixed like Lemonade's. That means if Lemonade hits a 17% market share just in the US, like Progressive has, Lemonade's probably going to be twice as profitable, 3 times as profitable. Okay. This is not hyperbole, which means that with a 16% market share for Lemonade, they're probably going to be a $300 billion company. Remember, right now, we're a $4 billion company. So that's almost a 100x in Lemonade if they can hit a 17% market share in just car. And Lemonade is not just car like Progressive. Lemonade offers home insurance, renters insurance, pet insurance, life insurance, okay? They're going to keep expanding their offerings as well. Also, Lemonade is not only in the US. Lemonade is in Europe. Lemonade is expanding to all of these different countries as well. Here, let me Google this as well. Which countries does Lemonade Insurance currently operate in? And this is just currently. Lemonade, United States, and this is not everything either. Okay, homeowners, renters, car, pet, and life insurance in the United States, Germany, Netherlands, France, United Kingdom. Okay, and this is just starting. We'll see what they say this quarter. Last quarter, Lemonade put up 200% growth in Europe year over year. Okay, so this is just crazy. I'm trying to really stress what sort of opportunity Lemonade is. It's a huge opportunity. I don't even understand how big the opportunity is. And I literally spent a year researching this company, 6 hours a day. Okay. And my stupid face wants to do some risk aversion and, sell a little bit of shares before earnings I need to see the forest through the trees here. Okay. To put our 7% result in context, many leading incumbents report LAE ratios around 9%, despite being at least an order of magnitude larger than us. Size typically brings natural efficiency advantages, so achieving a materially lower LAE while at a fraction of their scale bodes well. And then, like I said earlier, this is going to keep going down. Okay, we're going to see this 3.5-3% in the future, which means, like I said, 3 times. It's going to be 3 times lower than the current legacy incumbents. This progress is evident across our entire portfolio. Renters, home, pet, and car have all seen material LAE improvements, with car in particular demonstrating that even the most complex lines benefit meaningfully from AI. This reinforces that our advantage isn't a quirk of product mix. It's structural and directly enabled by our tech stack. Cost of handling claims by line of business. Also, we just passed 1,094 viewers on X. So hello, everyone. Thank you for being here. Glad you guys are learning about this company that I don't think there's another one I'm more excited about than this one. All right, so this is cost of handling claims by line of business. So they broke it down even further. So you can see car is currently the most expensive, but dropping rapidly. This is Lemonade overall. So this is this line here. That's this pink one. So then you can see that homeowners is about in line, and then pet is far below car right now. As soon as new AI technologies emerge, we integrate them directly into our infrastructure, often within hours of concluding safety and reliability testing. Ask Progressive to do that. Our even test AI technology, let alone implement it within hours. Okay. Our unified and proprietary tech stack means new capabilities plug right in and start delivering value. No rewiring or retrofitting needed. So we should talk about this for a second. It's a little bit of the elephant in the room, I guess. And that's Palantir, UiPath, these companies that are going into legacy businesses, kind of gutting the legacy business, reorganizing the entire thing, Honestly, if you kind of want to learn how this is happening, you should listen to Palantir's last earnings call. Reorganizing the entire traditional organization and changing unit economics. That's what Palantir is trying to do. Lemonade, from day one, has a Palantir living inside of it. Okay, it has a UiPath living inside of it. Anytime they do anything, they're already thinking, okay, let's build this in a way that it can be fully automated right from day one, because that's their DNA. That's why they started this. Progressive, on the other hand, I believe they just hired 18,000 employees this year. Progressive hires 18,000 employees. Okay, 1,200. 12,000. Okay, I was off by a little bit. Progressive Insurance intends to hire more than 12,000 people in 2025 to support companies' continued growth. Guys, is this the age of AI, or are we still several hundred years in the past? Okay. Traditional insurance companies do not have the DNA. They do not have the DNA to do what Lemonade's doing. They have too much legacy tech debt and legacy people debt. All right, let's get back to the shareholder letter right here. That's why we believe our efficiency frontier is still far from reached. In fact, we expect to cut our LAA ratio in half once more. I called it. Okay. In half once more, alongside the next doubling of the business. Incredible. And it is going to be 3 years too, like I said, because they're going to be growing like 35% a year. My gut feelings sometimes are just way too on. Okay. Guidance. Below, our view of how we expect the fourth quarter and full year 2025 to shape up. We have raised full year in-force premium and gross earned premium revenue and adjusted EBITDA guidance. You think the street likes this? When a company raises IFP, GEP revenue, and EBITDA guidance, and reiterate our expectation of positive adjusted free cash flow for full year 2025. All right, so Q4, you can see all the numbers here. They're expecting in-force premium of 1,218. Sorry, this is 1.1 million. 1.2 million to 1.22 million. Gross earned premium 283 million to 286 million. Revenue of 217 million to 222 million. This is getting close. This is creeping up a lot. This is a huge growth, by the way, because they're reducing reinsurance. So the revenue growth. Oh my gosh, what is the actual? What's the revenue growth acceleration number? I need to calculate that. What the actual revenue growth acceleration number that we saw was. Adjusted EBITDA loss is expected to be 16 to 13 million. Full year, 130 to 127 million. Could be, okay, they're not guiding. This could be the last adjusted EBITDA loss year, which we're experiencing history, guys. Enjoy it. Enjoy seeing a loss here. You're not going to see a loss here for long. Stock-based compensation expense, 18 million, 64 for full year. Weighted average common shares outstanding. Q4, 25 million, full year 24 million. Are they? How come shares are decreasing? Okay, I need to look at that. I don't quite understand this. Okay, this is weighted average. Okay. So the weighted average shares during the year was 24 million. Going into 2026, there's 25 million. Okay, that's a little confusing. Weighted average. Okay, I got it. We continue to expect 30% in-force premium growth in full year 2026. Simultaneously, we will continue to leverage AI to scale the operation such that we can deliver relative stability in operating expenses, excluding growth spend. Okay, so they're saying operating expenses, they're going to stay relatively flat. Growth is going to continue. I think it's going to keep accelerating. I wouldn't be surprised if, they put up a 35% IFP growth rate next year. Beat this relatively handily. We'll see. As a result, we expect to drive adjusted EBITDA improvements that sees us generating positive adjusted EBITDA for for the full quarter in Q4 2026. Okay. So they're saying we're going to flip EBITDA profitable in 2026. I'm saying they could be full year profitable. It might not just be Q4. Okay. I think they might hit. I feel, I don't want to say this because I don't want to like set expectations too high, but I think they're going to hit an EBITDA profitability before Q4 2026 personally. Okay. Q3 2025 results, KPIs and non-GAAP financial measures. So in-force premium, IFP defined. Oh, okay. This is IFP defined as the aggregate annualized premium for customers. So yeah, this is just premiums in-force is like current annualized subscription right now. Increased by 30% to 1.16 billion as compared to the third quarter of 2024. Customer count increased 24%, 2.8. Premium per customer increased 5%, now up to 403. Annual dollar retention defined as the percentage of IFP retained over a 12-month period, inclusive of changes in policy value, changes in number of policies, changes in policy type, and churn, was 85%. A decrease of 2 points from the third quarter of 2024. The decline is largely attributable to the non-renewal of policies which failed to meet certain underwriting criteria as discussed in prior letters. So if you guys want to understand what's happening here, remember how I said that as Lemonade's AI underwriter gets more and more data in that flywheel, the AI gets better and better at pricing the actual risk of each customer. Well, as that happens, the AI can realize, hey, some of these policies I sold a few years ago, they're not as profitable as I thought because now I'm a lot smarter. We need to non-renew these ones or raise the prices. And that's why you can get a little drop in ADR, because you either raise prices, which causes non-renewal, or you just say, this is just too much risk completely. And Lemonade just literally refuses to renew you. I've been seeing a little bit of hate on X. Sometimes you see someone like really mad, raging, like, how can you guys like Lemonade? They refuse to renew my policy. That's why we like them. Okay. That's why we like them, because they refuse to renew your policy. Sorry. Nothing personal. All right. Gross earned premium, third quarter gross earned premium of 274.7 million, increased by 61.6 million, or a 29% as compared to the third quarter of 2024, primarily due to the increase of IFP earned during the quarter. So in-force premium and gross earned premium, a little bit different. One is like the actual dollars you're bringing in. One is just like I said, the current, all the policies that are currently in force annualized. All right, revenue. Oh, here we go. Third quarter revenue of 194.5 million increased by 57.9 million, or 42%. 420, baby, as compared to the third quarter of 2024. Primarily due to the increase of gross earned premium, ceding commission income, and reduced premium cession rate related to quota share reinsurance following our recent renewal, as covered in detail in our last quarter. So if you guys don't know, when Lemonade was a new company and they're trying to train an AI to do underwriting, which can be very risky, right? Who knows if the AI knows what it's doing or not? During that period, you want to pay for reinsurance, okay? Because for a while, Lemonade had over 100% loss ratio. Okay, the AI wasn't that good, and you want to pay for reinsurance because you don't want a big catastrophic event or the fact that your AI is stupid to put you out of business. Well, that's not the way things are anymore. Okay, if we go back up here and we look at Lemonade's trailing 12-month gross loss ratio, which once again is the percentage of premiums getting paid out in claims, you can see this rapid drop as the AI gets smarter and smarter and smarter as it ingests and learns from more and more data. Now, Lemonade is at an industry-leading gross loss ratio. Let's look at what Progressive's gross loss ratio is. Progressive gross loss ratio, 69%. So, and that's really good, actually. I do not think they averaged that. They put up a good number, 69. That's incredible. I don't think I've seen that from Progressive in a long time. Anyway, Lemonade's better. Okay, Lemonade's already better than a $122 billion company. And they don't need to pay employees to do it. Lemonade's AI does it. And Lemonade's AI, guess what? It's just going to keep getting better. And just like full self-driving cars are going to be far safer than any human driver could ever be, full self-driving underwriting is going to be far better at pricing risk than a human underwriter could ever be. So now that the loss ratio is industry leading, well, guess what? It doesn't make as much sense to pay for reinsurance anymore because you're just giving away your profit to another company because you know how to price risk. Okay. You want to, if you have a low loss ratio, you want to keep all the risk on yourself because that means that you're not giving away free margin, free profit anymore. So as Lemonade, under generally accepted accounting principles, any percentage of a policy that is reinsured, Lemonade's not allowed to count as revenue. Okay. So even though it's in-force premium, even though it's Lemonade's customer and the customer is paying Lemonade, if Lemonade then goes and reinsures that policy, it's not in revenue. Okay. They can claim it as IFP. It's still in-force premium, but it's not revenue because it's going to someone else now. So as Lemonade drops reinsurance, and they're doing a big drop in reinsurance. Here, I'll show you guys. Reduction in Lemonade, or let's see, Lemonade reinsurance reduction. Just want to show you guys here, so you have the actual numbers. So they dropped reinsurance. So they were reinsuring 55% of policies. So that means of like $1 billion in IFP, they can only count $450 million of revenue. So the revenue looks half as good as it actually should be. Well, Lemonade, it doesn't cost them anything to then claim that revenue in the future. All they have to do is, next year, let's reinsure a little less. And that's what they did. So they announced that they were dropping reinsurance from 55% to 20%. All right. And this was the first of 4 quarters where we're going to start to see now 35% more of Lemonade's IFP is about to actually show up in revenue. Okay. So we're going to see a rapid compression in price to sales ratio for free. It's literally already revenue that Lemonade's collecting that they just can't claim as revenue because generally accepted accounting principles are a little bit stupid sometimes. So that means that over the next 12 months, we are seeing not only a 30% growth in in-force premium, we are also seeing a 35% reduction in reinsurance, which is going to add a huge additional tailwind to revenue growth. And that is why this quarter, we are seeing revenue grow by 42%, even as IFP only grows 30%. So that's, 12% faster revenue growth than IFP growth. And this is going to continue ramping. I believe more of the reinsurance is going to fall off next quarter than fell off this last quarter. And I expect that a couple of quarters from now, we might see like a 70% revenue growth number. All right. We're going to see 70% revenue growth, maybe more than that, simply because Lemonade is reducing reinsurance, keeping more of the risk themselves because their AI is a freaking juggernaut, brilliant underwriter now. And they don't need a reinsurer anymore. They're already better than all the Geico, Progressive, and the big guys. All right. Okay, gross profit. Third quarter gross profit of $79.9 million increased by $42.4 million, or a 113% increase as compared to the third quarter of 2024, primarily due to the 42% increase in revenue and 17 percentage point improvement in net loss ratio. Guys, is there a better company? Is there a better company in the whole world? I don't know. Many people would claim that right now. Many people would claim that. I'm not sure how many will keep claiming that 3 years from now. There's so many good companies though. Okay, no shade. I'm not throwing shade at your favorite company, just so you know. Okay, we're now at almost 1,500 viewers. So I appreciate everyone who is here. The Lemonade earnings call should hopefully be starting in about 15 minutes. Let me actually just check the feed here. Yeah, 8 a.m. Eastern time, which I believe should be 7 a.m. My time. So we'll get that ready in a second here. And we are at 50 concurrent viewers on YouTube. So way more people watching on X. Guys, X is the platform you guys should focus on if you want to grow an audience, by the way. I think X is going to start dominating YouTube more and more and more. Okay, but yeah, this is incredible. 113% increase in gross profit. 17% point improvement in net loss ratio. All right. Adjusted gross profit, third quarter adjusted gross profit of $80.9 million, increased by $42.3 million, or 110% as compared to the third quarter of 2024, primarily due to the 42% increase in revenue and 17 percentage point improvement in net loss ratio. Adjusted gross profit is a non-GAAP measure. Operating expenses, total operating expenses excluding net loss and loss adjustment expense of $141.2 million, increased by $16.7 million or 13% as compared to the third quarter of 2024. The increase was primarily driven by higher growth spend for customer acquisition. Growth spend included in sales and marketing expense was $46.1 million in the quarter as compared to $39.9 million in the third quarter of 2024. That's actually crazy. That's not as much of an increase as I was expecting. Because remember, they're growing much faster now than they were in the third quarter of last year. And not only are they growing much faster as a percentage basis, but they're growing at a faster percentage from a higher base, which means honestly, sales should have been much more expensive than that. That's really impressive. So this has to be a factor. The reason this was such a small increase year over year, this has to be because of the fact that 50% of new car customers are coming from the current customer base. Where did they say that? They were talking about car here. More than half of new car sales in the quarter came from existing Lemonade customers. This reinforces one of the core strategic advantages, the ability to drive customer acquisition cost-free sales to our growing base of happy customers, improving unit economics and expanding wallet share. Wow, it's real, guys, it's real. They've actually been adding so much IFP for free. Wow. Okay. Yeah, that's really impressive. That is really, really impressive. So marketing expense was only $46.1 million in the quarter as compared to $39.9 million in the third quarter of last year when they had lower percentage growth from a lower base. Incredible. Net loss. Net loss in the third quarter was $37.5 million or 51 cents per share as compared to $67.7 million or 95 cents per share in the third quarter of 2024. So we're looking not quite 100% increase, but when we flip profit, guys, this is going to be crazy operating leverage, and the profit's going to be really, really pretty. Adjusted EBITDA loss was $25.6 million as compared to an adjusted EBITDA loss of $49 million in the third quarter of 2024. This year-over-year improvement is primarily attributable to revenue growth and improved underwriting results, partially offset by the increase in growth spend. Adjusted EBITDA is a non-GAAP measure. Cash and investments. The company's cash equivalents, and investments totaled approximately $1,060 million at September 30, 2025. As of September 30, 2025, approximately $278 million is carried by our insurance subsidiaries as regulatory surplus. So cash balance is clearly growing. I believe we were under $1 billion in cash last quarter, and now we're over. Adjusted free cash flow. Adjusted free cash flow in the third quarter was $18.1 million as compared to $37.6 million in the third quarter of 2024. All right. So we can look at these key operating metrics here. Yeah. The only thing The only thing that doesn't look just absolutely stellar and almost mind-blowingly impressive is the annual dollar retention dropping slightly to 85%. But once again, remember that's because of Lemonade deciding to non-renew because their AI underwriter is better now and understands, hey, some of these old policies we wrote aren't as profitable as we thought they were going to be. But yeah, gross profit margin, that is so sexy. Adjusted profit margin. Yeah, these numbers are looking really, really good. Okay, cool. So I am now going to answer some questions here for the next 9 minutes while we wait for the earnings call to start. And we can just leave the page on that for now. All right, let me sign in here. I'm going to dox myself a bit, but that's okay. All right. So we're going to be hopping into the call here soon. Oh, I forgot my headphones are off. Let me turn those back on. All right. And let me see. How do I see comments here? Comments. Chat. I got the chat open now. Well, say hi in the chat if you guys are there. 1,500 people currently watching. Good to see everyone. Lemonade is currently up. Looks like about 10% in the pre-market. Which is solid here. I'm very interested to see what happens when market opens. And then also, what commentary we get from management here during this earnings call. Based on these numbers that we saw, though, this is going to be a very upbeat earnings call. Hey, Daniel. See you in the chat. What's up? This is going to be a super upbeat earnings call. I mean, I hope these analysts say thank you. I should say that. I just want to say thank you to Daniel and Shai and the entire Lemonade team. As an investor, I am just so grateful for this incredible company that you're building. I am so grateful for your foresight and the fact that you're going to be reducing the cost of insurance worldwide. Like, I was running some calculations, and if Lemonade's able to reduce the cost of insurance worldwide by like 25%, it is going to save trillions of dollars a year for the world that can be spent elsewhere. I was looking, the amount of savings, if we can reduce the cost of insurance globally by 25%, the amount of savings will be bigger than all but the 6 largest economies, like the 6 largest countries' economies. Lemonade cutting the cost of insurance by 25% globally would save more than all but the 6 largest GDPs, which is crazy. So what they're doing here is really important, really valuable. Okay, I am going to see if you guys can hear. I'm going to try to get sound set up here because I think, yeah, you guys can't hear that right now. There we go. Okay. I'm going to keep that muted for now. But we will be hopping into the earnings call in just a second when that starts up. For anyone who's just joining, because there are a lot of people just continually pouring into this stream, just as a reminder, Lemonade put up 30% IFP growth, 45% revenue growth this quarter, continuing acceleration in growth rate from just 18% back in 2023. And trailing 12-month gross loss ratio, which is the percentage of annual premiums collected that are paid out in claims, they just put up their best ever number by far and an industry-leading number of 67% trailing 12-month gross loss ratio. And then for anyone who's just joining as well and missed it, IFP is growing so fast, and over 3 years, operating expenses barely budged. So those are the highlights of the quarter. We also saw 40% year over year IFP growth in car. Lemonade's efficiency, thanks to AI, has doubled in the last 3 years and is set to double again. So we're just waiting now 5 minutes about until Lemonade's earnings call starts. Good morning. What was your biggest surprise this quarter? Asked Shaka. That's a really good question. The biggest surprise I had this quarter was how low growth spend was. Let's see here. Yeah, right here. Gross spend, excluding sales and marketing expense, was $46.1 million in the quarter as compared to $39.9 million in the third quarter of 2024. So they only increased gross spend by $7.2 million. Wait, is that right? Maybe even less than that. My math's not mathing. But it barely budged operating expenses as far as marketing expense goes. And their actual IFP growth rate compared to last year, let's see, Q3 2024, they only grew 24% from a lower base last year with almost the same marketing spend. So they increased growth rate from a bigger base with a slight budget in marketing expenses, thanks to this. More than half of new car sales in the quarter came from existing Lemonade customers. This reinforces one of the core strategic advantages, the ability to drive CAC-free sales to our growing base of happy customers, improving unit economics and expanding wallet share. That was my biggest surprise of the quarter. Because I was expecting, most of this other stuff is really good. This was also really impressive. I wasn't sure what this was going to come in at. I would have been happy with 69. I would have been happy with another 70%, So 67 is crazy. Really happy with that. But yeah, I think I was expecting gross spend to increase more in order to hit that 30% IFP growth number. So that was my biggest surprise. 42% revenue growth. Thank you, Aaron. Aaron, do you want to jump in here? I mean, we're about to listen to the call, so it doesn't really matter. Maybe I'll have you hop on after. If you guys don't know, here, let me do a little bit of a shameless promotion here while we wait for this earnings call to start. It's just right here. I'm listening, guys, even though you can't hear it. I'm listening. If you guys are not yet following us on YouTube, then make sure you follow us at How to Invest JB. This is my brother Aaron. We all make content. My sister makes content on here. My brother Aaron makes content, and then I make content as well. And we just talk about how I've averaged 180% annualized returns over the past half a decade. So yeah, I highly suggest subscribing here. And then for the 1,700 people watching live on X right now, if you guys are not yet following me on X at Jake Browatsky, I would really appreciate a follow. I went all in Tesla to become a millionaire. I kind of degened a bit in 2019. I spent 7 years on YouTube and I'd saved $20,000 over that 7 years. I started YouTube when I was 14. And I all-ined with that $20,000 in 2019 into Tesla and margin against it and went from $20,000 to $1.6 million of net worth. I don't recommend that necessarily, but that was my journey. I think if you have if you're, yeah, I don't want to comment. I'm not a financial advisor. This is not financial advice. And now I am currently all in Lemonade and Path. This isn't entirely true, but about 100% of my net liquidity is in Lemonade currently. And almost 100% of my net liquidity is also in Path. And then I also own some other positions as well. So I am highly levered in the market. Do not recommend that. But just a little bit about myself. So I share a lot. So if you guys want to know like my moves and stuff, like for example, yesterday, I literally just shared a screenshot of millions of dollars of market moves. Okay. I'm not charging $14,000 for a one-on-one call with me or something like that. I don't charge. We literally, you can't give us money if you want. Okay. We don't charge for anything, but all right, enough self-promotion. The earnings call is about to start. So let's hop over here. It is 7 a.m. So it should be starting right about now. As soon as they start talking, guys, I'm going to unmute this and I'm going to mute myself. Let me get a notepad ready so I can take notes for you guys. Let's see here. Where should I do this? Perhaps like right here would be good. All right. Here we go.
Good morning, and thank you all for attending the Lemonade Q3 2025 earnings call. My name is Brika, and I'll be your moderator for today. All lines will be muted during the presentation portion of the call, with an opportunity for questions and answers at the end. I will now hand over to the Lemonade team to begin.
Good morning, and welcome to Lemonade's third quarter 2025 earnings call. Joining us on our call today, we have Daniel Schreiber, CEO and co-founder, Shai Wininger, President and co-founder, and Tim Bixby, Chief Financial Officer. A letter to shareholders covering the company's third quarter 2025 financial results is available on our investor relations website at lemonade.com/investor. I would like to remind you that management's remarks made on this call may contain forward-looking statements. Actual results may differ materially from those indicated by these forward-looking statements as a result of various important factors, including those discussed in our letter to shareholders and the risk factors section of our Form 10-K filed with the SEC on February 26, 2025. Any forward-looking statements made on this call represent our views only as of today, and we undertake no obligation to update them. We will be referring to certain non-GAAP financial measures on today's call, including adjusted EBITDA, adjusted free cash flow, and adjusted gross profit, which we believe may be important to investors to assess our operating performance. Reconciliations of our non-GAAP financial measures to the most directly comparable GAAP financial measures are included in our letter to shareholders. Our letter to shareholders also includes information about our certain performance metrics, a definition of each metric, why each is useful to investors, and how we use each to monitor and manage our business. With that, I'll turn the call over to Daniel for some opening remarks.
Good morning, and thank you for joining us to review Lemonade's results for Q3 25. I'm happy to report another very strong quarter. Our in-force premium grew to $1.16 billion, marking our 8th consecutive quarter of accelerating growth. Our revenue was up 42% year-on-year, while our in-force premium enjoyed 30% growth rates we were not expecting before 2026. Happily, our strong top-line metrics were matched by our profitability KPIs. Our gross margin climbed into the 40s, while our gross profit more than doubled to $18 million, propelling us steadily and predictably towards EBITDA profitability in Q4 of next year. All our products and regions contributed to this dynamic of accelerating top line and improving profitability, though it is worth spotlighting car, which saw 40% growth, with more than half of that coming from existing Lemonade customers, essentially CAC-less acquisition. That's transformative to car's unit economics, as is the 16% year-on-year improvement in car's loss ratio, which came in at a lovely 76%. Staying with loss ratios, our company-wide gross loss ratio in Q3 was 62%, and our trailing 12-month loss ratio was 67%, both our lowest ever. If nothing unexpected happens in the coming weeks, I anticipate that we will set a new record once more this quarter, Q4. Against this backdrop, it's worth remembering that while declining loss ratios and expanding gross margins are a thrill, they are not per se what we are solving for. As I explained at some length during our Investor Day 1 year ago, the metric we are looking to maximize is gross profit dollars. Loss ratios always affect gross profit, but not always as a simple counter movement whereby lower loss ratios yield higher gross profit. In reality, the relationship is non-monotonic, meaning that often a higher loss ratio will yield higher gross profit. The underlying mechanics are obvious when you think about it. Given the incredible price sensitivity in insurance, each percentage reduction in price can often yield outsized returns in terms of conversion and retention. Lower prices worsen gross margins and loss ratio, yes, but the attendant boost in revenue often more than makes up for that. This means that for some parts of our business, certain products, certain channels, certain segments, a higher loss ratio and slimmer gross margins will actually translate into higher gross profit. Given the choice, we will always privilege dollars over percentages, which is why when we see an opportunity to trade higher loss ratios and slimmer gross margins for higher absolute gross profit dollars, we will take that trade 10 times out of 10. And indeed, as noteworthy as our loss ratio progression has been these past 2 years, during that time, my gross profit has surged by 261%. The full significance of this comes into sharp relief when we pair it with the fact that during the same time, our underlying expenses increased by single digits. This means that we've essentially transformed our variable expense into fixed costs. That's extraordinary. It's the hallmark of an AI-first company, and it is the reason why our gross profit trend line charts our path to profit and beyond. And with that, I'll hand it over to Shai.
Thanks, Daniel. I wanted to shed some light on something that captures one of the ways AI shows up in our results, the LAE ratio. For those less familiar with our industry, LAE, or loss adjustment expense, measures the cost of handling claims as percentage of premiums. It's a simple but powerful indicator of operational efficiency, and it is one of the few metrics that truly allows apples-to-apples comparison of the underlying efficiency of different insurance companies. It should be noted, though, that this metric is influenced by economies of scale, and so the larger the insurer, the more they are expected to have a good LAE ratio. For reference, large carriers typically report around 9% LAE. In other words, they spend about 9% of their premium dollars to handle claims on top of the claim payment itself. I'm happy to report that our investment in automation has been paying off, and despite our relatively small size in comparison to the largest US carriers, we reach a superior level of efficiency with an LAE of 7% on average across all of our products. In fact, in the past 3 years alone, we've cut our LAE ratio in half, and the number of Lemonade claims adjusters actually declined. All this despite our claim volume growing 2.5-fold. Using Blender, our AI-powered insurance operating system, claim adjusters are able to handle 3 times the claim volume they could before, all while providing our customers with a more transparent and instant experience. But having the best-in-class LAE is not where we stop. We wanted to take this further and expect to cut the LAE ratio in half yet again, in parallel with our next doubling of the business. With that, I shall lead off to Tim, who will cover our financial performance and outlook. Tim?
Thanks, Shai. Let's start with our Q3 scorecard. In-force premium grew 30% year-on-year to $1.16 billion, driven by customer growth of 24% and premium per customer growth of about 5%. We added a record 176,000 plus net new customers in the quarter. Gross loss ratio was 62%, an improvement of 11 points year-on-year and 5 points sequentially, while trailing 12 months gross loss ratio improved 3 points sequentially to 67%. Prior period development was 5% favorable, driven by 2% unfavorable CAT prior period development and 7% favorable non-CAT prior period development. Total CAT in the quarter, excluding the CAT prior period development, was 4%. Favorable prior period development was driven primarily by home, car, and EU operation, while the unfavorable CAT development was related primarily to the California wildfires in Q1. And on a net basis, prior period development was similar, with non-CAT about 6% favorable and CAT 4% unfavorable, for a net impact of about 2% favorable. Prior year development, which we report on a net basis, was $6.3 million favorable in Q3 and $18.9 million favorable year to date. Gross profit more than doubled to $80 million, as did adjusted gross profit to $81 million, for a gross margin of 41% and an adjusted gross margin of 42%. These metrics use revenue as their denominator. Adjusted gross profit as compared to gross earned premium was 29, up 11 points from 18% in the prior year. Revenue grew 42% to $195 million, while our adjusted EBITDA loss improved by about 50% in the year to a loss of $26 million. And it's worth highlighting that revenue grew fully 12 percentage points faster than IFP, a dynamic we expect to continue through at least Q2 next year, primarily due to the recent increase in retained business through our quota share reinsurance structure renewed July 1. Our Q4 revenue guidance, in fact, implies a roughly 49% year-on-year growth rate at the high end of the guidance range. Importantly, adjusted free cash flow was positive for the second consecutive quarter at $18 million, while operating cash flow was positive $4 million. And we ended the quarter with just under $1.1 billion in cash and investments, of which $278 million is held as regulatory surplus. Annual dollar retention, or EDR, began to improve again as expected and was up 1 point to 85% versus the prior quarter. Operating expenses, excluding loss and loss adjustment expense, increased by $17 million or 13% to $141 million in Q3 as compared to the prior year. And let's break those expense lines down a bit. Other insurance expense grew by $4 million or 22% in Q3 versus the prior year, versus a 30% growth rate of in-force premium. Total sales and marketing expense increased by $6 million, or about 12%, due to increased growth spend versus the prior year. In Q3, that growth spend was about $46 million, up 16% as compared to the prior year. We expect Q4 growth spend to be at a roughly similar level, which would put us at a total growth spend of about $180 million for the year. We continue to see both ROI strength and diversity across growth channels, where we've been able to maintain our LTV to CAC ratio above 3 to 1 across products, across channels, and across geographies. Technology development expense was up 13% year on year to $25 million, primarily due to increases in personnel expense, while G&A expense increased 11% as compared to the prior year to $35 million, primarily due to an increase in interest expense. Headcount decreased sequentially from 1,274 in Q2 to 1,259 in Q3, and was up about 3.5% versus the prior year, and essentially flat versus 24 months ago. Our net loss was $38 million in Q3, or a loss of 51 cents per share, as compared to a net loss of $68 million, or 95 cents per share in the prior year. Our adjusted EBITDA loss was $26 million in Q3, significantly improved versus $49 million EBITDA loss in the prior year. We're well positioned to continue to fund this growth, to expand across geographies, and to continue to diversify our customer mix. With over $1 billion of cash and investments, efficient capital surplus management, and positive adjusted free cash flow, we're well positioned to fund our growth strategy without need for additional capital. Given strong year-to-date performance, we are raising our full year 2025 guidance across in-force premium, gross earned premium, revenue, and EBITDA loss. Our expectation for positive adjusted EBITDA for the full quarter of Q4 2026 remains unchanged. And with the recent change in our quota share ceding ratio, we expect our ceding rate to continue to decline in Q4 to roughly 40%. Our Q3 results show continued execution on and ahead of our targets. 30% premium growth, double-digit loss ratio improvements, a doubling of gross profit, revenue growth well outpacing premium growth, recurring positive cash flow, and a strengthening balance sheet. We are delivering a unique combination of growth and profitability improvement, and are doing both at scale with real discipline. Let's talk through our Q4 expectations, and then we'll take some questions. For the fourth quarter, we expect in-force premium at December 31 between $1.218 and $1.223 billion. Gross earned premium between $283 $286 million. Revenue between $217 and $222 million. And an adjusted EBITDA loss between $16 and $13 million. We expect stock-based compensation expense of approximately $18 million and a weighted average share count of approximately 75 million shares for the quarter. And this implies for the full year, gross earned premium of between 1.044 and 1.047 billion, revenue between $727 and $732 million, and adjusted EBITDA loss between $130 and $127 million, stock-based compensation expense of approximately $61 million, and a weighted average share count for the full year of approximately 74 million shares. And with that, I would like to pass over to Shai to answer some questions from our retail investor.
Thanks, Tim. We now turn to our shareholders' questions submitted through the Say platform. Paperback asked, with the Loco and L2 announcement, what tangible things will be accelerated? As the number of car states we plan to launch in 2025 and beyond changed, are there any new products planned to be coming out faster? And will we see further operating leverage in our engineering teams? Thanks, Paperback. The Loco platform represents a major leap forward in how we build and evolve our insurance products. And yes, it's already accelerating a lot of what we do. For those who aren't familiar, Loco is what we call our next generation LLM-first no-code insurance product builder. And it effectively gives our teams a new way to configure, design, test, and launch complete insurance products and experiences without needing to write or deploy code. Loco is being built in a modular way, and it is already deployed and delivering value in some parts of the business, even though much work remains before Loco is complete. And based on the rollout so far, processes that used to take weeks can now happen in hours. And yes, it accelerates our operating leverage by freeing our engineering teams to focus on higher impact initiatives, since much of the product improvements and tests we're doing can be handled directly by our product and actuarial teams with no engineering involved. Paperback also asked, what is the reason or rationale for the recent board seat nominations of PayPal's CMO and Meta's VP of AI products? And are there potential partnerships with either company in the works? Paperback, the rationale for the additions of Jeff and Prashant to our board is that both of their areas of expertise, AI and brand, are central to Lemonade's strategy. Jeff and Prashant each bring exceptional experience that aligns directly with where we're headed as a company. Prashant is Meta's VP of AI products, prior to which he was Meta's VP of generative AI, giving him unique insight into how cutting-edge AI can be deployed at scale. Jeff is CMO at PayPal and Venmo, and was previously global head of marketing at Airbnb. So he has shaped some of the world's most loved and enduring consumer brands. As we continue to leverage AI to deliver delightful customer experiences and ultimately transform the insurance industry, their experience and perspectives will be invaluable in helping guide our next phase of growth. There are no specific partnerships with either company to highlight at this time. Our rationale is strategic expertise and not corporate collaboration. There are several questions about the future of FSD and how we are positioning our car insurance product in that shifting landscape. So I'll share some thoughts responsive to that general theme. This is an area we pay close attention to. The timeline for widespread autonomy is uncertain. It could take longer than the optimists predict or accelerate faster than most expect. And we're building with that range of scenarios in mind. Whenever autonomy reaches its tipping point, we believe we are well positioned to capture what many incumbents might see as a threat. The shift toward autonomy plays to our strengths. The future of car insurance is increasingly about pricing per mile driven and distinguishing between human and system-driven miles. Our system is built around usage-based pricing, real-time data, and flexible coverage, precisely the infrastructure needed for that future. And we don't have any legacy systems or traditional business models holding us back. Lastly, there were a number of questions about our Tesla integration. We recently announced a direct integration with Tesla's API, which, with proper customer consent, allows us to pull driving data straight from the vehicle. This gives us access to a much richer and more precise array of data than what's possible through a phone app or plug-in device. Things like seatbelt usage and more accurate trip insights, for example. It's the kind of granular telemetry that becomes critical as cars get smarter and more autonomous. Data that not only sharpens our pricing and underwriting precision today, but also positions us to learn directly from the evolution of FSD systems over time. As for insuring FSD miles at near zero cost, we aren't able to share material updates on that at the moment, but promise to do so when we can. What we can say is that integrations like these are early building blocks for a future where usage-based and system-driven pricing becomes the norm, and where our platform is already designed to adopt. To do so when we can. And with that, I'll pass it over to the moderator, and we will take some questions from the street.
Thank you. We will now begin the question and answer session. If you would like to ask a question, please press star, followed by 1 on your telephone keypad. If you change your mind and would like to remove that question, please press star, followed by 2. And again, to ask a question, please press star, then 1. As a reminder, if you're using a speakerphone, please remember to pick up your handset before asking a question. We'll pause here briefly whilst questions are registered. We have the first question from Tommy Merkjoint with Keefe, Bruyette and Woods. You may proceed.
Hey, good morning, guys. Thanks for taking our questions. You noted about half of new car customers were existing Lemonade customers, and thus were effectively CAC-less. How does that level compare to prior periods? And is the plan for the majority of new car customers for the foreseeable future to be CAC-less?
I would say that 50% rate has been consistent, plus or minus, for a few quarters now. So it's a good number. It's a stable number. The CAC-less approach is without question part of our focus, driving customers to multiple policies. We've seen growth in the multi-policy rate above 5%. It has increased sequentially every quarter for quite some time. But I would think of that 50% plus or minus number as a good stable number that we expect can continue.
Just to add to that, in addition to these customers being CAC-less, they are remarkable in other ways. They tend to have much better loss behaviors, loss patterns, so they are less costly not only to acquire but to service. They tend to have higher retention rates. There's a lot to love about these cross-sold customers. We in the letter we refer to them, or I in my comments refer to them as CAC-less. It would be more accurate to almost think about it as negative CAC. These are customers that tend to be profitable in whatever line of business we acquire them through, and then they add a car policy onto that. So it's really an important part of the business. I will just add that while 50%, or as we said, over half of our customers coming this way is a big deal, it's a core plank of our strategy, always has been. That part grows more organically, whereas the one that we target is less organic, and we have dials that we can dial that up or down. So the more you find us spending on acquisition, the more that will affect those ratios over time.
Got it. Thanks for the color there. And then switching over, looking at the ceding commission revenue line, was there a contingent or profit share tailwind in that ceding commission in the third quarter? It looks like it was a higher percentage of ceded premium than it had been running at.
The bulk of that ceding commission is driven by loss ratio, and because the loss ratios came in quite nicely, a record low in the quarter. As you know, there's a sliding scale of commission, so the commission varies somewhat up and down based on the loss ratio. There's a cap and a floor, a high and a low. So at some point, you cap out when your loss ratios get really, really good. So that was the main driver in the quarter. And probably worth a reminder, the ceding commission that you see on the face of the P&L is about 4 points different than the actual ceding commission, and that's an accounting nuance. I think you'll see an effective ceding commission rate of about 28% in the quarter, but on a P&L face, because of the accounting nuance, you see about 24%. So you're exactly right. A couple of points better both year and year and sequentially.
Thanks.
Thank you. Your next question comes from Jason Helfstein with Oppenheimer. Your line is open.
Hi, thanks. Yeah, I'm going to try to sneak in like two and then a quick housekeeper. So obviously we're seeing like impressive improvements in kind of the contribution ratio, efficiency. No doubt you are finding ways to use AI to make the business more efficient. That being said, where would you rate yourself on like at a 10, this would be us using all of the AI tools out there that we could and where you are? That's question number one. Question number two, again, you've got the business dialed in now between kind of growth and, marginal contribution improvements. Is there anything philosophically to think that you're going to lean more into growth because of the way the business is and the metrics are playing out? And then lastly, Tim, just expenses were up on a year-over-year basis and sequentially in the third quarter, like OpEx, i.e. technology and G&A, more than we've seen in a while. Is there just anything to call out from an expense standpoint in the quarter? Thanks.
Hey, Jason. Good morning. So the AI is now, the impact of our AI deployments, I think, is now reflected on pretty much every line in our P&L. So you're quite right. We see it almost anywhere you look. We spotlighted the LAE as a way to really provide apples-to-apples comparison, and that way you can see how dramatically different it is from the incumbency. You could look at the fact that with our OpEx, our gross profit has gone up tenfold in the last 3 years, whereas our headcount hasn't moved, has actually moderately declined. So there are a lot of indications of something pretty dramatic happening in terms of the AI, and you see that in terms of all the efficiencies. And if you look at the life cycle within kind of the customer engagement with Lemonade, you'll see AI everywhere. It starts with how and where we deploy the marketing dollars that attract you as a customer. So as you know, about 90% of those dollars that Tim referenced earlier that we deploy to acquire customers, about 90% of them are guided by AI. Some 50 different machine learning models that optimize how we spend, where we spend based on LTV to CAC predictions of every customer, every segment, every advertising campaign. Then when you come to us, our recommendation of products and all different other settings and cross sales during the purchase process is AI driven. And then later when you engage with us and ask customer support or claims, you'll see again the majority of our claims being settled without human intervention by AI. So by one measure, I would say that we score very high on your 1 to 10 scale. We really do use AI across the board. The majority of our code, software engineering is now written by AI. So we're really seeing this everywhere. At the same time, I think if you take a zoomed out perspective and you kind of judge today by where we will be a year, 2 years, 3 years from today, I think you'd rate us as a 1. I think we're just getting started. And there is so much more that we see that we can do. We're scrambling to do it all. As we are doing that, the ground beneath us is shifting because the models are becoming so much smarter, so much faster. So I think both we have done a lot and we have done very little, one measured against what the industry knows and the other one measured against the potential that we see coming over the course of the next few years. I'm sorry, just another word about your second question. Tim, do you have that?
Yeah, it was about just philosophically, now that everything seems to be kind of working, would you consider leaning into more growth and pushing out kind of profitability targets? And then there was the housekeeping question expense.
Okay, so yes and no, and we tried to touch on this in our earlier comments. We see ourselves turning EBITDA profitable in Q4 of next year. That's not moving. I don't anticipate any change in that. That's been our expectation for some 3 years, and it's becoming increasingly obvious, I think, to people outside the company why we're so confident of that. So that particular profitability metric is unlikely to change. But there are other metrics that talk to profitability, such as gross margins, which we see as more pliable. So what we are optimizing for is gross profit dollars. And in pursuit of maximizing gross profit dollars, there will be segments where we will let loss ratio rise because the elasticity of demand is such that will spike demand and retention in a way that offsets the margin becoming a little bit more constrained. So depending on which, pick your metric and I'll give you a better answer. The gross profit dollars we expect to maximize, and we don't expect to take our foot off the pedal there at all. And the ultimate EBITDA break even is locked in for Q4 of next year, and we're not anticipating that changing.
Great. And then a couple notes on the expense side. You're right that the tick up in this quarter was a little higher than is typical. We do see it vary quarter to quarter. I don't see that as a step change or an ongoing change. But particularly in the quarter, growth spend obviously is a notable year-on-year increase, and we break that out. We're spending a bit more for tech personnel, and you see the offsets from that in efficiencies elsewhere. But that's a dynamic where if you isolate that line over time, you can see some increase there year-on-year. Some of it just purely inflation. The team size doesn't grow dramatically, but the cost goes up modestly. In G&A, our interest expense grows, and that grows with our growth spend more or less because we're financing about 80% of that growth spend. So from an expense standpoint, it jumps out, but from an overall cash flow benefit standpoint, obviously that's a terrific benefit to our the IRR measures of the company as a whole. A little bit of noise in our merchant fees, which can be seasonal, meaning they can move a little bit more or less than the premium in the quarter. So a number of little things, but the big picture is unchanged. Single-digit expense growth and 30% plus top-line growth, and you see that in the chart that we publish, and that's what we expect going forward.
Thanks.
Thank you. Your next question comes from Katie Sykes with Autonomous Research. Your line is open.
Hi, thank you. Good morning. A couple from me. I guess first, it sounds like there's a bit more growth spend scheduled for 4Q than previously messaged the last time you hosted a call. So I guess I'm just trying to reconcile the change in the IFP guide for the full year 25, given the magnitude of 3Q results relative to previous guidance. It doesn't sound like you're messaging necessarily a pull forward in growth into 3Q from 4Q, but it kind of does seem like the full year guide implies a bit of a sequential deceleration next quarter back down below the 30% growth rate. So I'm just looking for some additional color there on the change in the full year guide when 3Q IFP netted out, relative to the previous guide.
Sure. Hey, Katie, your math is right. So when we have a big beat on a key metric in a quarter, then obviously we evaluate how much of that we expect to continue forward and how much we want to make certain adjustments on the top line. That IFP number captures the entire business, not just the additional sales or the new sales or the growth rate. So while our growth spend is increased and our new sales we expect will increase as well, we're cautious about retention. Our Q3 results were actually quite good, and we're able to overperform. But we're somewhat thoughtful about that top line going into Q4 because that captures the entire business. The opposite is true on the other line items. So in gross earned premium and revenue, we captured not only the beat in Q3, but additional increase in Q4. So there's a little nuance there between the metrics. That's what's going on.
Okay, yeah, no, that makes total sense. It's just, ADR, to your credit, improved versus last quarter. It's, showing upward progress there. I understand, obviously, some of that is coming from the lapping of non-renewals on home from last year. But, it looks like you guys are doing well in terms of retention versus to maybe we were at the start of this year. So I'm just you know, curious about the conservatism. Like, you were able to exceed the 30% IFP growth rate this quarter. So, you know, what in the financial plan is potentially looking a little bit less positive as we end up the year, especially as retention continues to improve?
I would think of it as all quite positive if you're looking for our view and how we see things rolling out, particularly in the fourth quarter where, you know, we're a month plus in, we have pretty good visibility. I'd remind that we continue to be really thoughtful about our home book of business. The underlying numbers actually look quite good, the loss ratio and the other metrics, but we continue to work through what we've called our clean the book exercise. That continues unchanged. Actually, it'll have a level of impact in the second half that's similar to the first half, but that continues, and that's part of our plan. So we're growing at a 30% rate despite that sort of pruning of our customer base. So all your questions are fair, but I think we're quite optimistic. I just want to be thoughtful about the parts we know about and the parts we don't yet know about, which is the remainder of the quarter.
And maybe, Katie, just to add the benefit of, sorry, just for the benefit of people listening on who haven't done the math as you have, that a guide does anticipate a 30% next quarter at the high end of the guide. So we've guided at something between 29 and 30% growth for Q4. So we're certainly not anticipating or guiding to any considerable reversal or slowdown as guided.
Okay. And then if I could just sneak in one more, you know, I can appreciate that the trailing 12-month gross loss ratio is trending well below the 73% target you guys have previously messaged. Just kind of thinking about that in the context of the changes to the quota share structure and ongoing maximization of gross profit dollars. Is a 73% gross loss ratio still the right target for the business at this point, or do you eventually see a pathway to taking that target down lower?
It's a great question, Katie. And to be honest, we've tried to be responsive to questions such as this one and provide a target loss ratio. But I do want to give you an insight into how we think about this, which is that there isn't a target per se. Loss ratio is an input, not an output. It's a lever which we use to optimize the business. It's not necessarily evidence that the business is optimal. So because we are as efficient as we are and our other cost structures are declining as they are, we are leaders, a thesis that we developed at some length almost a year ago during our analyst day on November 20th of last year, which is to say, we think that there is a structural advantage that Lemonade enjoys, where in a price-sensitive market like ours, where oftentimes a 1% move on price will yield a 5-fold increase in conversion or other metrics, it may make sense for us to continuously refine within certain markets and certain segments, get to very competitive price points. Now that will put pressure on gross loss ratio. But just to give you a hypothetical, you know, I spoke earlier about the catalyst acquisition of great customers in the car business. Why do we need to optimize to a 73 or any other particular number for these customers where there is no cost to acquire the customer and almost no cost to service the customers? You can envisage a situation where we could lower prices so dramatically where we would be profitable with a 90% loss ratio. The math here and the degrees of freedom that we have is pretty dramatic and something that will be very, very hard for the incumbency to replicate. So we are using the data to guide us in terms of what is optimizing gross profit. At times that will mean selling a lot more with thinner margins, at times not. Some of our products are more price elastic, some are less. Some campaigns are more elastic, some are less. So it will aggregate into a loss ratio that we will report on a quarterly basis. But we're thinking about loss ratio less and less as one big aggregate number with a target, more and more as fine-tuning of optimization of by product, by campaign, by region, and that will result in different loss ratios, different product lines, but always in the service of maximizing gross profit. I hope that helps give you an insight into how we are approaching the question that you're asking.
Thank you very much to you both. I appreciate the color.
Thank you. We now have Zachary Gunn with FT Partners. You may proceed with your question.
Hey there. Thanks for taking my question here. So I also just wanted to follow up on the gross loss ratio. So down 5 points overall, 13 points in Europe. So can you just talk a little bit about what drove that decrease in Europe? Is it benefits of scale? Was it product mix? And then just I'll get my follow-up in on that topic as well. I think previously you've talked about UK being really strong in Europe from a growth perspective, maybe Germany being a little bit weaker. Any updates there within the European market of what you're seeing? Thanks.
Sure, Zachary. Let me start it off, and then Tim, please come in with anything that you feel I missed. Our European business is doing spectacularly well. We put a spotlight on it a couple of quarters ago, I think, but it really is. We're seeing something like 170% growth in our European business this quarter. We're seeing our customer base doubling year on year and a very healthy loss ratio. I think we mentioned in the last quarter, if memory serves, that when our American business was at this size, this dimension, its loss ratio was 30 points worse than we are in Europe today. So things there are moving along the same trajectory as our US business, but to some extent, we've learned lessons and built systems, and to some extent, the nature of the European business allows us to do things faster. And let me just unpack that last sentence for you, which is in the US, as you know, regulators across the 50 states have varying requirements, but by and large, there are systems, hoops, loops that we have to jump through before we can affect price changes. Not so in Europe. In Europe, there are other regulatory constraints, but we have freedom, or much more freedom, to price and to change prices dynamically, which means that when we pick up signals in terms of pricing inaccuracies, there isn't the time lag that we have in the US. We're able to course correct instantly, and our systems are set up to do just that. So we are seeing that our business there is much more responsive to any signal that we pick up, and I think that as much as anything else, we've got a fabulous team, we've got lessons learned and some scar tissue from where we misstepped in the past, but that more than anything else has just allowed us to move at a pace that we just can't in the US. Tim, anything you wanted to add to that?
Yeah, just general good news across the board, I think, and particularly from a loss ratio perspective, we're starting to see some mixed benefit. So as the UK grows, and in particular the renters book in the UK, that sports a nice, effectively low loss ratio, that starts to show up in the total. So that's part of the driver. Some of it is prior period impact, also favorable in the quarter, and that's good news. That just means when you have a younger book of business and you're more thoughtful in your reserving, you can at times have a favorable release of prior period. We saw a bit of that in our French book, which is a smaller book of business. With the UK heading in aggregate above the 50% level, that bodes well. But we're also seeing nice improvements in other territories as well. We've gone from having really no home business in Europe to having a really nice and effective home product now in 3 of the 4 territories. So Europe is really hitting on all cylinders. It's still a relatively small portion of the book, but it's become material, and you'll likely hear more about it from us as we go forward.
Thank you. Your next question comes from the line of Andrew Andersen with Jefferies.
Hey, good morning. Just looking at pet, it's been growing pretty well, and the loss ratios seem pretty stable there. I was wondering if you could just touch on kind of the competitive environment you're seeing with pet, maybe how you feel your pricing is relative to some of the industry, and if you could maybe touch on what you're seeing in terms of loss trends there.
Yeah, again, I feel like a broken record. The things I said about the EU are also true in pet. Super stable and predictable loss ratios at this point. A little bit of seasonality. The partnership with Chewy continues to hum along. About almost 5% of the business now has been driven through that partnership. From a competitive standpoint, we've done in 4 or 5 years, I think, what it took pet-only providers that are really, really strong players in the market, 10 or 12 years to do. So we really like what we're seeing from a pet perspective. From a pricing perspective, I would think of it as similar to our other products, where while we don't aim to be to underprice the product or to be price anything as a loss leader, we'll often be, if not the least price, a super competitive price. So we do lose business if it doesn't satisfy our LTV model requirements, but we're typically quite competitive with the strongest players.
Thank you. And I just want to go back to some of the LAE comments and the potential for improvement in that ratio over time. I'm just trying to think about how you are managing kind of maintaining a similar customer service level, but also taking into consideration, I imagine at some point over time, there will be a pivot back towards some more homeowners, and auto will be a different or a higher mix of the book. So how do you kind of manage through the different customer service levels and the changing needs there, but also using automation efforts?
Hi, Andrew. You'll note in the letter we break down the LAE by product, and you'll see that there's a uniformly down and to the right shape to all of the curves, all of the products, including the more complex ones that you're asking about. So we are seeing that we're able to use AI across the board, across the product line to great effect and to achieve dramatic improvements in terms of automation. The very nice thing about using AI to do this work is that it's never at the cost of customer service. It is to the delight of customers. The overwhelming majority of complaints that we get, I think well over 90%, are about things that humans do rather than AI does. So when we deploy AI to do these things, it's not the old thing that you used to get when you dialed, United Airlines, and you'd have to repeat yourself 7 times to be understood, and press 1 and press 3 and press 5, and you knew you were interacting with a machine. These are very high level. We only deploy the technology once it reaches very high levels of customer satisfaction. And once it does that, it usually exceeds, or in the areas that we agree to let it go live, it exceeds what humans do because it's much faster. The error rate is often lower. So we're seeing it able to handle ever more complex things. Jason asked me earlier about kind of a scale of 1 to 10, and I think that would apply here as well, which is you can see how much we've done, and at the same time, we just think that there is a whole lot more that we can do. We really do see a blue ocean in front of us of areas that we can improve. So we're fairly bullish on, kind of if you zoom out, on the prospects of AGI within the next few years, which really means that machines will be able to do every activity, every intellectual activity that humans do today. And therefore, the idea that some of these products are more complex and require humans today is both true and transient. I think in the coming years, you'll find that we'll be able to deploy systems to take care of all of our customers' needs, lowering our costs, and raising the level of customer delight.
And I think I'd add a thought. Sorry to interrupt. I think there's a note or two in the letter that's kind of elegant around this concept of shifting variable cost to fixed cost. And so if you think from a customer satisfaction standpoint or a customer experience standpoint, very specifically, in the older world, even if you automated responses or interactions with customers, you had to have a human evaluating and improving those responses so they were constantly improving and getting better. And that human evaluating those responses became a variable expense. They had to review and think and make judgments, even though they weren't actually responding to every request. With the tools, with the AI tools we now have at hand, even that review process with a human intervention can be automated such that an improvement in a response can filter out to our entire customer base in real time. And so this concept of constantly looking for variable expenses that we can convert to fixed expenses is a really, it sounds simple, but I think in the world of AI, it really helps to kind of sharpen the focus on how these things actually turn into things you can see on the P&L.
Great. Thank you for the answers.
Thank you. Just a reminder that it's star followed by one if you wish to ask any further questions. We have Jack Matten with BMO Capital Markets. Please go ahead.
Hey, good morning. This is Charlie on for Jack. I'm sorry we joined late, so apologies if you addressed this, but we saw Shai tweeted this morning that Lemonade plans to start lowering rates. Can you elaborate more on the timing and magnitude of when you may plan to file for these rate cuts and which lines of business are you talking about specifically? Thanks.
Hey, Charlie. Yeah, we've addressed this both in my opening comments and in answer to previous questions, so I'll keep my comments brief. I didn't see Shai tweet what was alleged. So I think what Shai said is that, or certainly what he meant to, the point that we're trying to get across is that, there is a sense in which and there was a question about this earlier, we've achieved everything that we said we were going to achieve in terms of loss ratios, and they're at record lows, and we're anticipating them potentially going even lower this coming quarter. And yet we don't always see, this is a moment to kind of take a victory lap, and we're thrilled with it and it's excellent, but we don't always see lower as better. That's what we were saying. And there are times when you can optimize gross profit with higher loss ratios as well. And it can be counterintuitive because you think lower means more profit, but it also means taking a hit in terms of conversion and retention. And the smart thing as far as we're concerned is to optimize not for a particular loss ratio number, but to optimize for gross profit. It's what we do. And all that means is that different loss ratios for different products, different campaigns, different regions over time. There's nothing dramatic. We're not signaling any filings that are imminent, or we're not guiding to a new target loss ratio or anything like that. We think the loss ratio, in fact, will continue to improve in the near term. Just saying that it's important for our investors to be aligned with us about what metrics are important ultimately. And we think gross profit is the one that we're solving for, and loss ratio is an input to it. I hope that clarifies that.
Yeah, sorry about that. Thank you. And I guess for my second question, I know you've already adjusted your main quota share program to retain 80% of top line. Are there any other changes regarding your broader reinsurance program that you're thinking about heading into the new year, given the expectation for reinsurance costs to continue to moderate?
Yeah, I would say we're right on track with our typical approach to reinsurance, which is we're constantly thinking thoughtfully about what we might change or improve, but structurally that renewal comes in July. We have the opportunity to add or subtract things during the course of the year, which we do almost never, but we certainly have that opportunity. So we're constantly looking at those ways that we might help manage both the benefits of reinsurance from a volatility standpoint, as well as managing capital surplus, and that really is the driver there. But we are in a great position with the renewal that came through at July 1st. We're heading toward the point by mid-year next year where we'll be ceding just about 20% of our premiums and losses to our quota share partners. As you know, it takes a while to flow through the book once you get to a renewal as the business renews over the course of the year. The impact of that will be such that in Q4, our effective overall cede rate might look more like around 40%. So you're seeing, as expected, that decline as we move closer and closer to the next renewal. In the early part of the year next year, we'll start to get more serious with our partners as we have in the past, and think through what that next renewal might look like.
Thanks. If I could just sneak in one more, any color on the competitive environment in pet? It feels like we've been hearing, more public insurance carriers, talking about that business more and more. Thanks.
Nothing notable. I think we're still finding, it's funny when you kind of look at the market from a competitive standpoint, you hear about either Google algorithms changing or competitors getting more aggressive, and these things definitely happen from time to time. But if we look at our Q2 results, our Q3 results, our view into our guidance for Q4, it's really steady as she goes. Even frequency and severity of claims in the quarter was not notable, and that's good news for that book of business because it is, continues to grow in terms of its share of our overall business. So while we kind of track the competitors, it's not top of the list of the things we think about. The things we are doing are working. They're working well. And pet, as it has been for quite some time, is a key pillar that enables us to grow at 30% plus.
Thank you.
Thank you. Our final question from the phone lines comes from Luke Nelson with Cantor Fitzgerald. You may proceed with your question.
Hi, and nice to meet you all. I just have a couple of brief questions this morning. My first question being, with car, it's roughly around 15% of IFP today. Where do you guys kind of see that mix trending long term? So, is 25% the right ceiling? And, are there limits on auto exposure we should be thinking about?
So best indicator, I think, is to kind of think back a bit to our recent investor day, which is about a year ago now. So it's not quite so recent, but we sketch out a plan and a vision to track and drive growth at the company from $1 billion of premium to $10 billion. And what we sketched out at that time was a car component of that of around 40%. I would think of that as sort of a thematic share, but a pretty good one. Could be more, could be less. The TAM for car is in just the U.S., not to mention Europe, which we don't have a car product in yet, but in just the U.S., it's just an enormous potential market, and even just our own customer base is an enormous market for us. So there's really no restriction from a TAM perspective. It's about us optimizing the LTV to CAC, really driving that cross-sell dynamic, because that's what helps us with retention. The gross loss ratio improvement was terrific. So if you think about a mid-teens ratio today and a 40% car share at $10 billion, your number is not far off. 20%, low 20s is certainly within reason in the coming couple of years. The nice thing about Lemonade is the mix of business is quite diverse, and so that number can ebb higher or lower, and we'll still be well able to track to our growth rate targets overall. But I think car will end up in that range that you're thinking about.
Gotcha, that makes sense. And then just my last question is a two-parter, and you might have touched on it previously, but I noticed retention increased to 83%, but ceding commission increased as well, despite the reduction in reinsurance. So can you kind of walk us through that dynamic, and where do you expect retention to trend over the next few quarters? Thank you.
Sorry, if you could, I think I misheard your question. Was it around ceding rate, or was it around retention?
Right. So yeah, my question was, I noticed retention increased to 83%, but at the same time, ceding commission income also increased. So can you just kind of walk through the dynamic between the two, and where do you expect retention to trend over the next few quarters?
Yeah, so a couple of metrics just to pull apart there. So we disclose a retention metric, which is a customer metric. So ADR is annual dollar retention. And just as a reminder, that's, the dollars from any given cohort of business 1 year later, how much have you retained? And that number has tracked upward nicely from the 70s to the high 80s over many, many quarters consistently. It dialed back a couple points over the past few quarters because of our home effort to clean the book, and we had some non-renewals there that tamped that number down. We've now seen that reverse, as we expected. It went from 80 up 1 point this quarter sequentially. So it feels like we might be back on track to have that number increase. That's customer retention, stable and improving. From a ceding commission standpoint, that's a different part of the business, and that's really related to the premiums we share and the losses we share with our quota share partners. And so that I kind of send you back to our earlier comments about the quota share renewal. So at July 1st this past year, we were ceding, June 30th, we were ceding about 55% of our book of business. That has shifted such that it will move from 55 to about 20% over the 12 months from Q3 to Q2 that we're in right now. The commission we earn on that is a variable rate commission, and that's you'll see that pretty clearly outlined in our 10Q disclosures that we'll file today, so you can kind of dig into the nuances there. But we continue to get a mid 20% roughly ceding commission on all the premium that we cede to that partner. And so we'll cede fewer dollars. That's a good thing, but we'll continue to earn a healthy commission rate on all those dollars that we cede to our partners.
Gotcha. That makes sense. Thank you.
Thank you. I can confirm that does conclude our question and answer session here, and I'd like to conclude the call. Thank you all for your participation. You may now disconnect, and please enjoy the rest of your day.
Wow, wow, wow. What an incredible quarter. That was really, really impressive. Yeah, I don't I don't have anything negative to say about that. Like, I was afraid for no reason, to be completely honest. I mean, I felt pretty confident. Well, I knew they were gonna accelerate growth a lot because of the reinsurance reduction. I also felt quite confident about loss ratios this quarter because there were no big disasters or anything like that. But they just continue to impress. Even my most bullish expectations, they just absolutely destroy them. It's crazy. I love that they are now sharing LAE so that we can see how efficiently they're handling claims. It's incredible that they've cut it in half over the last 3 years, and they're going to cut it in half again. I don't think I'm bullish enough on this company, guys. That's my takeaway from this. I do not think I am bullish enough on Lemonade, and I have 100% of my net liquidity in the company. Oh my gosh. Yeah, I don't know. Do you guys have any questions? This quarter was honestly more impressive than Q2. And in Q2, we ran 30% on earnings day. So we're already up about 17% in pre-market. Guys, remember the short interest on Lemonade is insane. So shorts are about to get absolutely destroyed today. Let's look at this up. Let's look this up real quick. Cloudflare needs to confirm that I am a human. Okay, so short interest as a percentage of float is 25% of shares outstanding. So a fourth of shares outstanding are currently sold short. And for those of you guys who don't know what that means someone has borrowed shares, but likely from me, because on Interactive Brokers lends out my shares to short sellers. So they probably borrowed their shares from me. They then sell the shares, and they have to buy them back at some point. They have to buy those shares back. So 25% of shares outstanding have to be purchased by short sellers. And the longer they wait to buy these shares back, the more money they are just burning. They're just burning money. I think we're headed to 80. So I'm a long-term investor. I own Lemonade because I think that it's going to become the biggest insurance company in the world over the next 20 years, 30 years. I think it will be $1 trillion company in 30 years. So I like to think really long term. And I try not to make short-term predictions because how a stock moves in the short term is completely based off of sentiment, which I don't understand how sentiment can't continue to increase with banger quarters like this. But short term's based on sentiment. Long term, the stock price always follows free cash flow per share. So I try not to make short-term predictions because I can know what Lemonade's going to do next quarter. I can't know how the market's going to react to that, if that makes sense. That said, I will be shocked if Lemonade is not above $80 before the end of this year. That would shock me. And honestly, if we pull back to 60 again, I might consider, going back to like 200% leverage into Lemonade or something like that. Like literally being like 100%, like match my equity with margin. And I don't recommend anyone do that, but I might do that. Because this is a generational opportunity in a generational moment in history where we are having a productivity revolution bigger than the Industrial Revolution, bigger than the Internet revolution. And it's allowing for humans to accomplish work without working, which is crazy. So Lemonade has been able to reduce the size. Okay, listen to this. Okay, this is not hyperbole. If you weren't here during the beginning before the earnings call, just listen to this. Okay, notably, our claims department shrank in absolute terms, even as claims volume increased by 2.5 times during the period. In the call, if I look through my notes here, I believe Daniel said at one point that thanks to AI, also, by the way, loss ratios are going to keep going down, which is also insane. That means gross margins are going to keep going up. But I think he said that due to AI, claims processors are now 3 times more efficient. I'm trying to look for this. Oh yeah, EU grew 170% year over year. Not bad. But let's see here. Yeah, single-digit expense growth while growing top line 30%. Revenue grew 42%. Yeah, gross profit has 10x'd in the last 3 years while headcount has declined. AI models optimize where we spend, how we sell, how we cross-sell, how you engage with customer support, how we pay claims, how we code. Everything is AI. Lemonade said that they're 10 out of 10 in AI compared to incumbents, but they're 1 out of 10 in AI compared to where they'll be in a few years. Oh my gosh. I had a feeling. Did you guys have this feeling? I had a feeling that the analysts were like a little bit kind of like dumbstruck. Like I don't think they fully processed these numbers they were hearing. Maybe that was just me, but that's what I felt like. I felt like they just, they couldn't quite even believe what they were hearing because AI is allowing Lemonade to do something that these far bigger companies with far more economies of scale can't even do. Wow, that was incredible. All right, guys. Well, thank you all so much for watching this coverage of Lemonade's Q3 2025 earnings call. There are 3,000 of you watching live on X right now, which is just absolutely incredible. About 100 people watching live on YouTube as well. If you guys did enjoy this and you want to see more coverage on Lemonade, then make sure you follow me on X and on YouTube. I need to think about what I'm going to do before market open. If I want to degen more shares of Lemonade, I'm actually considering that, which is crazy because I sold $1 million of Lemonade at $60 yesterday. And I'm thinking of degening back in. I'm putting the $1 million back in at 68. I mean, I only lost $160,000 from that move, so it's not too bad. But it's like you have to think about this in context, right? Like, okay, yeah, the move turned out to be quite poor in hindsight. But my portfolio is up over $1 million in pre-market. Okay. So I'm going to be okay. I'm going to cry into that $1 million that I'm up this morning. while I think about that $160,000 fumble that I made. Yeah, we're headed to $1 trillion market cap. I mean, how do I sell a company at $4 billion that I am 99.999999999% sure is going to become $1 trillion company someday? How? Because I'm foolish, short-term thinker. Okay, nice. Oh, okay. Hopefully we get a little pullback. A tiny pullback here would be nice. But yeah, I think I'm gonna wait. I'm gonna see how we open. What I'm gonna do is I'm gonna put in an order, like a limit order, probably at like $64 at open, and hope that we have like a big spike down, like right at market open. That happens sometimes, and my purchase goes in at 64, and then we spike back up. It's probably what would happen. So yeah, I think I'm going to put in a limit order at 64 for market open, and hope we get a little spike down. So Harmon Kang says, F it, Degen back in 5 years, it won't matter. Yeah, no, that's very true. That's very true, Harmon. But yeah, guys, thank you so much for watching. Retweet this if you want more people to learn about this 10x opportunity. And I will see you guys all on the interwebs of X. I love reading all your comments and stuff, and I love being transparent and sharing all of my retarded moves with you as I somehow, despite being completely fallible and foolish, still destroy everyone that you see on CNBC. Just so you guys know, the people you see on CNBC, like they're lucky if they're averaging like 8% returns, like if they're lucky, because 80% of professional money managers are losing to the S&P 500. And all these degens on X that you're following, we're averaging like 100% annualized returns. Since 2019, I have averaged 180% annualized returns. So just don't watch TV unless you want to laugh at the CNBC analysts. Don't listen to people like Jim Cramer. That is my word of advice for you as I depart. So have a great day, everyone. Enjoy market open. I know I will. And please buy equities. Please buy assets. AI is going to be transforming the economy, and it could be hard for a little bit, okay? A lot of people's jobs are automatable. A lot of people's jobs are automatable. So own equities, because your job might be automatable as well. And owning a company like Lemonade is a perfect hedge to the fact that computers are getting smarter than you and me. So yeah, that's my advice.